everyone, and welcome to the Creative Financing Podcast. I'm Nicole Kamanjian. I'm here with Cody Richard and the host of this show, Jeff Rappaport. This is episode 218, and today we're going to continue talking about evaluating and deal structuring of 1 to 4 units. While listening to this episode, if you have questions, please head over to our Facebook group, the Creative Financing Podcast. If you're not part of that community, just search the Creative Financing Podcast in Facebook and ask to join. On the second Thursday of every month, we're going to have a live session, so you can bring your questions for Jeff. If you're watching this on YouTube, you can ask your questions in the comments below. And if you're getting value from this episode, please like, share, and subscribe to the show. We also want your feedback, so please rate and review wherever you listen.
Thank you, Nicole. All right, so we're going to continue on with the last episode. So we're going to now look at a single family home, and we're going to look at it as potential. This is how I like to look at every lead, right? So the first thing that comes to my mind, is there a whole bunch of equity that we can wholesale it, or we could wholesale it, or we can offer a cash price and buy it cheap, okay? And then the whole next wave of ideas are, does it make sense cash flow wise in one way or another, right? As a rental, as buy on terms, sell on terms, buy on terms, lease option, buy on terms, rent out, whatever the case may be, okay? So here is, can you guys see my screen?
Yes.
Okay, great. So here's a property. It's a 3-bed, 2-bath. It's built in 95. It's on 1/3 of an acre. The seller owes $144,000, and payments are $675, principal and interest. And Cody, this was one of your leads, right? That this guy was rehabbing this property and fell short, right? At least that's what it sounds like. He says it still needs about 10 grand, but it's pretty minor stuff, and pretty much everything else has been remodeled.
Yeah, got it almost to the finish line and ran out of money.
Yeah. So we believe that, and we have some values kind of all over the place. Mohammed, our transaction coordinator, he thinks this property is worth $255. I wanted to be a little more conservative, and so I'm putting it more like $230, $240. The taxes run $27.19, and he wants $180, right? And I don't know if he's making money at that price or not, and I don't really care. It doesn't really matter. But which was very unusual, right? He must have gotten bank financing, because this doesn't seem like it's a hard money loan, right? So 144 and 675 is your payment. He must have gotten a good loan on it, and that would certainly be something that we will verify if we get to that point. All right, so again, we would want to run our comps. We came up between 230 and 240, and we're going to run our rental comps. So just so you know, I feel like the two best places to run rental comps, and maybe there's more than two, but I use Rentometer and I use BiggerPockets. BiggerPockets has a tool in it that works pretty well too. I would tell you, if you're just starting out, you can use the free versions on both, but you want to get serious, you got to pay the money. You could also go on Zillow and look at rentals. You could call property managers in the area, but verify what the ranges are. Okay, so it's $1,550 to $1,750 a month, and it may even be higher. I want it again be a little more on the conservative side. So we're going to do exactly what we did in the last episode, which is, let's see what our total rents are going to be, minus a little vacancy, minus all our expenses. That's going to leave us with our net operating income. How much money can we afford to give the seller how much money can we afford to, how much cash flow do we get to keep for ourselves. Okay. So gross rents, I just took the middle ground here. I took 1650 times 12. Now vacancy on this is a single family. Hopefully, eventually, if we're doing a straight rental, someone might be in this property for the next 5 years. We may not have a vacancy, but we're going to include it anyway, because you could have it after 1 year. So, and if you don't want to use 10%, don't. I'd be okay if you use 5% here. Okay. So we come to a total amount of 18,810 in terms of rents. Okay. And then what we do know, taxes are 2719. Now, depending on what market you're in, some of the higher markets like California and I believe like New York, taxes will be reassessed at the time of a purchase. And so they can go up significantly. In most states, they do not. They may get reassessed some point during the year. Sometimes they go down a little, sometimes they go up a little. But but we were looking at a property in California, and the taxes were like $22,000 for the year. And if we bought it, that the broker estimated that the taxes would be around $80,000 for the year.
Jeez.
So that's a major difference, right? Okay, so I'm estimating insurance, basically $100 a month. I'm estimating that, hey, water, sewer, garbage might be a utility that you pay. You may not, right? On a single family home, it's a little easier to pass on, all the utilities to the tenant. So again, I'm going to figure out everything. And if I have to modify it a little bit, I can. Even management, right? We're going to take 10%. Repairs, I have no idea, but I'm figuring this property was just rehabbed, right? That shouldn't need much in repairs for the next few years. And maintenance, right? So lawn care, pest control, whatever that may entail. So total expenses are $82.85, and that leaves us about $10,525. Okay. And remember, even down here, many of these expenses could be eliminated if we're looking at other potential exit strategies other than holding as a straight rental. So if our NOI is $10,525, which does not include debt service, right? We have not figured anything out. So what, again, if we went through a normal bank and that same kind of example, right? We're financing 144 at 6% for 30 years. And we have a very similar payment to what we had in the last example, right? 863 times 12, right? That would be our total debt for the year, right? So we want these numbers to be on the same. I could divide this by 12, or I could times this by 12, okay? We want to compare year to year or month to month, one or the other. Okay, so it comes out to be $10,360. Nicole, do you want to buy this property for $180 and put down $36,000 to get $200, almost $200 a year in cash flow?
No.
What do you think your cash on cash return will be?
I don't even know, like 1%.
Yeah, terrible, right? Terrible. You might do better leaving your cash in the bank than to do this as a rental, right? Now, it could get better, right? Maybe we get rid of, maybe we'll manage it on our own. Maybe we can pass on the water, sewer, garbage. Maybe we could pass on maintenance. I don't know, but still, it's not going to be super good, is it? If we save $1,200, that's $100 a month. that this is $85 a month. So maybe we're making $215 a month, right? Nothing to get super excited about, and I'm not going to spend $36,000 out of pocket, right? But could we look at this a little differently? So as a straight rental, no, I'm not interested. But what if I did a lease option? Okay. And I'm still looking at this as if I am going to just go get a loan with the bank, right? So, but now what if I find, instead of renting it, I'm going to do a lease option, and I'm going to find a tenant buyer. And I'm going to sell this property again on the conservative side for $240. If this has all been rehabbed and it's really worth $240, we can sell this for more. We probably could sell for $260. So, but with a rent of $1,700 a month. Okay. So we're going to still be responsible for the taxes and insurance. Let's call that $300 a month. So we're only getting $1,400, but we're not going to be responsible for the maintenance, the management, or the repairs. Now, if we finance the property, and we had a payment of $863 or $10,360, is that what our payment would be? Cash flow. So if we're getting $1,400 net times 12 equals 16,800 minus 10,360. Yes. All right. So really all I did here, we're still responsible for the taxes and insurance. Okay. So this nets us $1,400 a month, and I times that by 12. Okay. And then I subtracted out the debt service. That leaves us $6,440 for the year, or $536 a month and some change in net cash flow. Okay, that's a lot better than the $20 a month that we were looking at. It wasn't even 20, right? So now we're at 536. Okay, if we sell this as a lease option, we're going to get what's called an option deposit from our buyer, and that's kind of the security deposit, kind of down payment that will go toward the purchase if they exercise their option in the future. Okay, so, and doing lease options all across the country will vary. I know places where you can get closer to 10% as an option deposit, but most of the markets that I've dealt in, you're looking at more of that realistic 3 to 5% of the purchase price. Okay, so if we're selling this for $240, let's say we're going to get $10,000 down. Okay, if we get our $10,000 down, we had to put down $36,000, right? Now there may be some closing costs. It wouldn't be a whole lot, but we may have a little closing cost. But so we've recouped 10 of it. So we're out of pocket. How much?
26,000.
26,000, right? So if we now take our 6,440 divided by 26,000, our cash on cash return is almost 25%. Is that good, Nicole?
Yep, that's a whole lot better.
It is a whole lot better, right?
Yep. It makes it a deal, basically.
Well, and the only real negative, so you still get the depreciation to write off for your taxes. The only negative is that you have locked in a price in an appreciating time. Let's say that you give a 3-year lease option. In 3 years, this property could be worth another 50 grand, or it could go down, right? We don't know. But if you don't mind doing a lease option, this is a ton better way of doing it, even which I would not recommend. Me personally, I would not go to the bank and get a loan for this property. I just wouldn't do it. But if you were going to do it, doesn't this make a ton more sense than to do it and try to hold it as a rental? Now you're basically hoping for appreciation, right? Here,
Yeah.
I don't even care. It could stay the same for 3 years. And whether they get the loan or not, it doesn't really matter to me, right? Basically, I'm going to make my money back in, what is it going to be?
About 4 years.
Is it 4 years? Yeah, so I'll be into it for 26. So that's the one negative that I don't like about this, is that we got to leave this amount of money in the property. If we were leaving 3 or 5 grand, 6 maybe, hey, not a big deal, right? But we got to leave 26. That might prevent us from buying another property. So that's why, and you make more money on this if the buyer ends up buying. You get paid off, quite a nice little sum of money. You do pretty well here. So this is a not bad scenario. We can do better.
Your logic basically for that was just, where can I cut the expenses, basically, is what you did to make it.
And that's basically what a lease option does, is that it passes on some of the expenses to the buyer, and it helps you kind of maximize your cash flow while still maintaining ownership. The negative is that you're giving an option to buy. If you don't really want to sell, you don't have that choice any longer. That becomes the buyer's choice. Okay.
Yep.
I prefer this method. And so first is sell on terms, right? Okay. Again, if this property is really worth 240, we're selling this for 260, 265, not 245. But I just wanted to show you, hey, I'd rather be conservative than aggressive, right? Now we're going to get 10% down, and I'm going to be kind of adamant about that, because I want someone to have that kind of money in this property. And if they don't, more than likely we're going to run into a problem. I don't want that problem. So I'm going to get 10%. I might get more, but 10% is fair. Okay. I'm going to sell this property at least at 9% interest, which you may say, what? How in the world are you going to do that? What was the rent?
1,700.
1750, right?
Yeah.
And I told you even that it's possible it's worth even more, right? So this would put us at a payment of 1770 a month. Okay. What if now I'm being too aggressive? Let's say that I can't quite get that. I've got to go down to, so if we're financing 220 at 8% for 30 years, it's 1614. The taxes, what did we think the taxes and insurance run on this?
300.
So 27, so like let's call it like $4,320 maybe a month. So if we sell this at 8%, our payment goes down to 1614. And then if we add in the 300, that they're around 1900 total. So even if we had to come down even a little more, right? 7.5%, that will get it done. 1538. To me, that's too cheap, but if you had to, you have that room. Okay. But
And so just to make sure I understand, on the last one, the rent, we were just getting the raw rent, and then we had to pay taxes and insurance.
right.
So that's why it can make sense here.
Yep.
Because that 1770, or if it needs to go lower, is just principal and interest.
That is correct.
And then the person that buys it from us is paying taxes and insurance.
That is correct. Yes.
Okay.
Yep. So Now, in this case, we're owed the difference between 220, right? Because they're buying it for 245. They put down 25. They owe us 220. We owe 144, remember, because we put down $36,000. So we didn't recoup all our money. Okay, but we have a difference. We have an equity position of $76,000, and we've recouped 25 grand. So now we're out 11, right? What's our payment? Our payment is what, 865, I think it was 863. That we're making how much? $900 cash flow. Okay, so 900 times 12 is 10,800. We're out 11,000. What's your cash on cash return? Basically 100%.
Yeah.
Right? Okay. So you see, if we just switch up some of our exit strategies, we make this deal way better, right? Let's think about what if we switched up not getting that bank loan and what we can do, right? So we're always thinking about our potential exit strategies when we're trying to decide on how to structure offers. Okay, so do these look familiar, Cody? These are kind of the offers that we made, I believe.
Yes, they do look familiar.
Yeah. Okay, so the first one is, hey, I will buy the property subject to the mortgage, which basically means what, Nicole? I'm putting you on the spot.
Yeah, you did.
Yeah.
Subject to the mortgage. I'm not positive on that one.
Cody, you want to help her out?
Yeah, basically taking over the seller's underlying debt. It'd stay in the seller's name, and then the title would transfer.
Yep.
And then in this scenario, we're giving them some equity up front too.
Or maybe all of his equity. Right?
Yeah.
And I don't care, right? So you could structure this one of two ways. Now, remember, if we went to the bank, how much money do we have to put down?
36.
Yeah. So if we did it this way, if we put down 36,000 this way, it's no different than the bank, right? Except that what was our payment? 865.
Yeah.
And his payment is 675. So we get $200 more cash flow for giving him all of his money now. What if we just said, well, we'll give you most of your money now, and we'll give you the balance over some time. We'll either pay you some money, or hey, in 5 years, we'll pay you off the balance, or whatever. We could. That way, we won't be out any money up front, right? Because would you do this deal, Cody, so to me, it's a no-brainer, but let me ask you, if you had not one penny in this deal and you just had the cash flow and the back end part to it, would you do this deal?
Oh yeah, makes a whole lot of sense.
But what if you actually had 10, 12 grand out of pocket? Would you say, hey, I still got to make this work, whether I've got to pay it out of my own pocket, or I got to, what, Nicole? What could I go do?
Borrow money?
Yeah, that's right.
Other people's money?
Could I borrow 10 or 12 grand and afford to pay someone a decent return to make it so that, could I borrow 20 grand and actually put a little money in my pocket up front if I needed to?
Yep.
You could, couldn't you? This deal affords it, doesn't it? So, I have two ways that I could structure some subject to deal here, right? Where I could just give him all his equity, or I could give him most of his equity and figure out a way to structure the rest. How about if he's willing to stay in this a little bit longer, and when I say that, some of his equity, right? So now we offer him more money, right? We're offering him 15 grand more than what he was asking. But we're not going to give him as much money up front. And so maybe we give him 10 or 15 grand. What are we going to make sure we get as a down payment? 10%, right? $25,000. So now we're up that money, right? No matter what, we will end up being, we will be putting money in our pocket up front. Okay. But what if we paid him interest? Yep. So we wrap this entire deal, right? And we're paying him 4.5 to 5.25. If I remember right, this guy said he would be willing to finance for little money down, but he'd want a bigger payment, like 1,000 or 1,200. Well, how about somewhere in the middle? We'll give you some money up front, and we'll give you a payment of 937 to 1,021. Doesn't that still net us a pretty good cash flow?
Yeah.
And now we don't have to go borrow any money. We make money up front. We have a good net cash flow every month, and maybe we can get him to extend this out, right? So maybe 10 years, 15 years, maybe longer term. Because me personally, I'd rather pay him more and be able to get that $600 a month cash flow. It might not be the 900 that we were, looking at in the previous example, but hey, would you take $600 a month cash flow for up to the next 10 years on a property you don't own?
Yeah, and a property that you make money at closing too.
Yeah, you have no money into, right? You've already made some money, and you get paid every month. And the only issue might be is that, hey, maybe you want them to get financing because you have a significant back end to this, right? Where you're going to get paid, a significant amount of money. And that's becomes more of a business decision based on what your, where your business is and what you're trying to accomplish. A lot of times you want this to keep going as long as it can go, right? We just showed, hey, you could buy that three units with the storefront, and the chances of you generating $600 a month it's a stretch. Here it's a single family home, and you didn't go to the bank and get a loan. You didn't personally guarantee anything, and you made money. There's no money that you have to come up with. If you were doing this as a beginner, you didn't have to have any money, right? So that's why we look at these properties in different ways, because there's at least several ways that we could look at buying it, including conventional. We could make it work if that's all but there's so much better ways, and let's incentivize the seller to do it. And we saw that, hey, could I rent it? Could I make this work as a rental? If I structured it this way, yeah, probably could. If we did the first option, and we now have a payment of $675, and I'm getting, let's call it $1,400 net. I'd still have them. I might be able to pass on some maintenance. I might be able to not have management, but I could now I'd have a decent cash flow, but still, I'm trying to skirt some of the expenses to try to create my cash flow when in either the lease option or selling it on terms. I don't have to. I can create that same cash flow or more. And yes, I know I don't have the depreciation if I sell it. I don't have the potential appreciation with either of these. I don't care. How many more of these deals can I go do? Because it costs me no money. I can do 10 of these, 20 of these a year, a month, whatever. If I'm paying $36,000 for every deal that I go get, how many of those can I do, right? So if I'm just starting out, I might be able to do one. Now I got to start saving for my next one, right? So I like these strategies a whole lot better. Was this helpful to either one or both of you?
Yeah, big time.
Yeah, this is super helpful. And I'd say, I mean, if you're newer or even experienced in writing offers, it helps to take the time to go through all these different options and, I mean, see what the best outcome could be. Because if you're just like, okay, I'll just do traditional owner financing, and you try to run it through, it may not work as well as a subject to or a wrap of the mortgage. So
Well,
making sure you look at the options.
do you see why me personally, this is why I like to run these calculations, right? Because it really shows you what you have to work with in terms of money. Now, in both examples, in this episode and the last one, I had to estimate a bunch of expenses. That happens, right? And I might be right, I might be wrong. I'm just trying to get in the range, right? I just wanted to see if I can make it make sense, and then I'll go verify stuff. But I'm not looking to hold these as rentals, so I already know I don't care. This part doesn't matter to me. I showed this because others do. Others do want rentals. I just want cash flow. I want notes. Do I do a lease option every now and again? Yeah, I would be okay with that. But for the most part, I don't want rentals. I want notes. And so I can skip this part, right? Really what I needed to do was my upfront, analyzing the leads, running my comps, running my rental comps. I want to know what potential taxes are. And that's really all I need to know that, okay, how can I, and then Cody did his job, which was, hey, he asked the right questions when he talked to the seller. Seller said, I'm willing to carry. And I just assume, to be honest, go ahead and take the subject to deal. I'll pay you the $36,000. I'll borrow it, or I'll figure out how to come up with that money. That's fine. I'd rather just take over your debt and just be done with it. And then we will turn around and wrap it to a new buyer. And this one will be a great one. Any last questions?
Nothing from me.
Nope.
Awesome. All right. Well, we appreciate your time. Hopefully you found this helpful. Certainly give us some feedback. We're always looking. We're doing this for all of you. So if you want to hear some different topics, let us know. Join our Facebook group. Go out and create some terms.